We saw some headlines around drone attacks on Russian refineries and so on, and tensions in the Middle East. I feel like they're really sort of the default story. So there isn't a lot of geopolitical premium being priced in at the moment. What do you say?
I think it's hard to say there's none, given what's been going on over the course of the sort of past year or so. A bit of a residual there makes sense, but I don't think that there's a large geopolitical risk premium at this point, and really that reflects the fact that although we've had so many potential disruptions, if we go back obviously just to the starting point of Russia's invasion of Ukraine and then obviously subsequent events over the past sort of year in the Middle East, none of them have actually led to a meaningful disruption to supply, and I think therefore the market understandably is largely discounting it. So that, in an asymmetry perspective, there's scope for a much greater geopolitical risk premium, but in terms of our base case, it's just not something that we think should happen at the moment, because there isn't really anything that would yet justify it, and so I think the market's response is quite fair in that sense.
Marcus, moving over to what's happening with iron ore, which has lost ground to now the lowest in over 2 months, and partly because of what's happening over in China. We've been talking a lot about this, and of course the lacklustre steel consumption is partly to blame. Do you feel that iron ore has further to run to the downside?
I think in the very short term, if you're going to have a move below $100 a tonne, that's perfectly plausible. It's very evident that the market is in a physical surplus. You can see that in the build that we've got in port stocks. But I think it's hard within, say, the back half of this year to trade below 100 for any sustainable basis. And the reason for that, really, in our mind, is twofold. I think one, if you look at marginal seaborne supply, and the biggest portion of that at the moment is India, if you look at the ship tracking of Indian exports, they're very, very price sensitive, and we saw earlier in the year when prices briefly dipped a bit below current levels that material pulled back. And if that were to happen again, I think the loss that you would see means that we would actually then start to expect a meaningful draw in port stocks, such that you get a bit of price support. And the other thing is that if you're going to have a really substantial sell-off and to trade at low levels for an enduring period, I think you need to see weaker steel production than we currently have. And although a policy-mandated production cut is always a possibility, and I would stress it would need to be on a national level, not just a regional one, to have a big impact on the market. But that on a commercial basis, although mills' margins are not good, I don't think they're low enough on an aggregate, at the aggregate level, to drive big production cuts. And when we look at how mills are currently behaving, they're actually optimizing for productivity at the moment, not optimizing for cost minimization, and that would also suggest that they're not about to cut. So that our base case would be that actually the prices towards the bottom end of a range here could trade a little bit lower, but that you should be seeing some support come in at around this sort of $100 level. And we'd actually think that on a sort of 3 to 4 month view, prices are probably pushing back up to sort of 110 or so.